It's not completely guaranteed for the following reasons. One, because one of the reasons that the RBI was able to cut rates is because inflation is behaving itself. But if commodity prices start going up, that's not an impossible scenario. It's not going to go back up to where it was before, but even if the trend is that there's an increase, then that feeds very quickly into inflation. The weather still plays a very important role in India. Food inflation, which the RBI has very little control over, has an effect on its headline numbers. So there is no reason to at this point think that there is a clear downward trajectory in interest rates.
We are discussing the possibility of a rate cut when the world is discussing negative rates. Do you see this sustaining? This debate sustaining, and would India continue to receive the kind of capital flows that it has in the last 5 years?
If the world starts raising rates?
Yes.
So yes and no in the following sense that the expectation from the Fed is that while they will very likely raise rates another round before the end of this year, it's not going to be a big jump, and it's not going they're hardly going to signal that this is going to be a big increase. Continued sustained increase. Secondly, the rest of the advanced world is still very much on an expansionary monetary policy path. Europe and Japan. Japan is trying unconventional monetary policy in ways that pretty much nowhere else in the world it's being tried. So there's going to be I think the world economy is going to be flush with liquidity. Now, there's a huge demand for safe assets in the world. People want to put their money where you're guaranteed to get very safe returns. If India can signal it's one of those countries where somehow these are now safe assets, then the Fed raising interest rates will have minimal impact on the Indian economy.
Mr. Majal, when you talk to investors globally, are you seeing the interest to invest directly into India? FDI. The government is doing whatever it can to sort of attract that. Are things changing on the ground?
Yes, to my mind, positively, they are changing, and on the interest rates and inflation here, the signaling is quite positive, and a lot of us believe that going forward we will see both of them coming down, which in other words is going to bring in more investments.
No pressure on the RBI.
I think we're seeing sustained interest around the world in investment in India, covering services sectors, manufacturing sectors. Manufacturing is relatively recent. It's a reflection of the Make in India program. Where we're starting to now see interest also is in labor-intensive manufacturing, which is a first. With large electronic assemblers setting up plants in India. I think that's a first, and that's a very productive first for the country, I think, going forward. On the inflation and interest rate question, I think the last cut in interest rates 2 days ago was really a continuation of policies that have been in place for the last almost 2 years. And I think we should see it in that light. We should see us as a country that is transiting to a low inflation, low interest rate regime. And that transition will lay the foundation for 20 years of growth.
Okay. Geeta, you alluded to commodity prices. India's fiscal arithmetic looks good purely because oil has been where it is. And even 20 years ago, 91 happened, the balance payment crisis happened because in 90 you saw a huge spike in oil prices. What if oil turns around, and how significant a risk that is to whatever we're talking about?
It's certainly been a plus for India, the fact that commodity prices have come down, both on the fiscal deficit and on the inflation end. If and when commodity prices go up, I think that there is some more time before that happens because there's still slowing growth in the world. With low demand, I don't know where the source for price pressures are going to come up. But if that turns around, that could have an important effect. But to the extent that there's been the moving away from petrol and diesel subsidies, the fact that the government has tried to market at this point the prices, it should not be as severe as in the previous regime.
If there is a turnaround, do you think India is better positioned to handle a price shock?
So I agree. I think that I don't expect anything imminent. I think it's a couple of at least a few years out, and I think in that time frame, we have to have all of these market-linked pricing in place so that it doesn't then start affecting government finances. Will that then have a really adverse effect on the economy if it happens, say, 5 years out? I think if we've properly connected pricing with the market, it will have a minimal effect.
Sure.
My views on this are pretty heretical. I think our interest rates have been way too high to encourage capital formation. Making 10% on business as earnings is a miracle. At 10 or 11% rate of interest, where is the capital formation going to happen? And that is why you have been seeing right through that our actual investment in industries has been coming down. Interest rate has been a very substantial part of it. And let me tell you, the way the kind of vicious circle which has been generated. Our inflation is low, money moves in, but even after converting it, you get a return of 9 to 10%. And even if there's a depreciation, it's 2 to 3%. So your foreign exchange has remained, reserves have remained high. But it is basically largely on basis of money which is flowing into the country purely because our interest rates are high. I was involved I was working for the World Bank and involved with East Asia when the Asian tigers were coming up. I used to head that group. Basically, interest rates, they brought it down. Look at Korea. Their growth was based largely on low interest rates. China, they can determine anything, and that is what encouraged capital formation and increased productivity, brought down inflation as is. Now that is one way of going it. We have been going the other way, which is a monetarist way. I don't know what comes out in the wash, but as I said, I am a bit of a outsider on the normal discussion, which talks of tiny margins, 0.25% here, 0.25% there. That ain't gonna solve our problem.
Okay. Sure.
We are directly impacted by oil
Yes, of course.
and commodities. And I think that discussion would be more relevant in October 17 or October 18. Right now, we are pretty much safe.
Okay.
Not worried.
Okay. From now to, let's say, the end of the tenure of this government, what can be the government's priorities? GST is done. Do you think the government will take land and labor reforms head on?
I wish they would. Again, for industry, for manufacturing, both are very, very important. And right now, both are hindrances. For expansion, it's so difficult to get land. For expanding again your manufacturing, your capacities, labor is extremely. Whatever mechanization we do, we still have very large numbers employed. There are lots of issues, all of us have. So these two are very, very important, and I wish all of us in CII can push for those with the government.
Do you see the government taking on labor reforms as an issue?
So I think the government's position on land and labor reforms is clear. They've said, look, it's politically very contentious, and they find it very difficult to move on land and labor reforms at the central government level as of now. But what they've said very clearly is that, look, we're encouraging the states to move on land and labor reforms. There are now 6 states that have moved on the labor reform side. There are 3 states that have moved on the land reform side, some quite fundamentally in their changes. And I think the expectation is that there should be about 10 states in the country that move significantly on labor reforms, 10 states that move significantly on land reforms. And if you have that, you're pretty well done, because then you could either say, we will recognize this centrally, or you could simply say, well, okay, all the investment is going to go to those 10 states, and you're still done.